We are Clarity Financial doing business as RIA Advisors. We're a registered investment advisor here in Houston, Texas. This is purely informational, so we want to make sure we cover a lot of information. Let us jump right in. So we talked a little bit about Social Security. Rich and I do believe that the trust fund will be there. The Old Age Survivors Disability Trust is not going anywhere in the sense that many people need it. 62% of retirees right now require it for more than 50% of their income. Actually, a quarter need it for 90%. So Social Security will be here. We don't want you to make an emotional decision, a rash decision. This slide right here just talks about what those lifetime benefits look like. We talk about a lot, and we use it in, $2,000. What if it's $2,000 versus $2,300? We like to put these in lump sums. This gives you a perspective of how long you live, what that will be, and assuming a 2% cost of living adjustment. That is, there's a pretty substantial amount of money that you're going to potentially have here. Also, what does that mean with cost of living adjustments at 2%? You see in 10 years, it goes up to $2,400, in 20 years up to $3,000, and 30 years up to $3,600. So the strategies we're going to talk about, we're going to give you a lot of examples on what do you do if you're married? What's the best way for you and your spouse to take? Divorced, widowed, and then what if you remarried? Are you still eligible for your ex-spouse benefits? So we're going to talk a lot about that. So Rich, let's talk about the questions to ask.
The one thing I want you to understand that Danny went over is, with women especially, women outlive men. Social Security is not a break even on how long am I going to live and collect my benefit and get everything out of the system. Social Security is your insurance in case you live longer. And we are living longer, and women live even longer. So that's how you got to look at this benefit. It's longevity risk insurance. Do you qualify for benefits on your own record? That's a great question to ask, right? That's when you pull your Social Security statement and figure out, how long have I done this? Do I have zeros in my on my statement that I need to fill? Very important. Yeah, are you currently married? And has your husband received benefits? It'll become clearer later as we've gone through this. Even important, have you been married before? Are there any former husbands, dead or alive, lurking? Right? Believe it or not, you're going to earn on your former husband's work record, right? If your previous marriage ended in divorce, it lasted at least 10 years, and if you're currently unmarried, you can qualify for divorced spouse benefits. That's great. And even if your ex-husband is deceased, you could receive benefits. Yeah, and again, you don't have to memorize these rules. We're going to explain them a little bit more, but what I'm trying to say is there are a lot of women out there that do not realize that they are eligible for benefits because their spouses are not calling them and going, hey, ex-wife, you got my benefit. You better check it, right? You're going to have to do it.
Yeah, man. And just because you can take a benefit doesn't mean that you always should. A lot of times delaying is going to be in your benefit, and make sure that you don't take it emotionally. We see this often where an ex-spouse says, you know what, I'm going to get them for everything that I can. I'm going to go ahead and take their Social Security right now. Well, guess what? If you take it, they'll never know. It doesn't impact what they receive. So make sure that you understand the strategy that's best for you or you and your spouse, and do the best thing for you as a whole. And so I think that's always one thing that needs to be considered. Talking about what you could be entitled to, a retirement benefit if you're married, a spousal benefit, or your own benefit is your retirement benefit, spousal benefit if you're married, a divorced spouse benefit, and then a survivor benefit. So we're going to talk about how do you coordinate that. There's a lot of acronyms thrown out there. You hear FRA, PIA. So we're going to talk a little bit about what those mean. So FRA is your full retirement age. That's when you're eligible to receive your full benefit without a deduction in benefits or a reduced amount. And so if you're born before 1954, your full retirement age is 66. Between 55 and 59, each year they increase it by 2 months of when your full retirement age. And if you're born in 60 or thereafter, your full retirement age is 67. We talked about, we do believe Social Security will be here. Little small things they may do. They could increase this from 67 to 68. They could make small changes in other areas.
I think, Danny, you need another box that says 1970 and later. Yeah. And then make that 68. That would probably help.
Which is really a shame because, you see when the average person retires, it's actually much sooner than their full retirement age. A lot of times just due to health or health of a loved one or, job layoffs, a number of things that occur. But Yeah, I think you're right, though, unfortunately.
Well, studies also show that men will retire earlier because they want to take Social Security at age 62. And guess what? They die sooner. There's a study out there that links early death to taking Social Security early as a male. So your primary insurance amount is exactly that. That's how much benefits you've earned to qualify. And this is a really important part of your statement, right? When you pull up your Social Security statement and you go to ssa.gov, you want to go right to your estimated benefits box. And you want to see what your full retirement age benefit is. But look at, and we're going to talk more about this, so I don't want to get into it, but you really more want to focus as a woman on the next box, which is age 70, what your payment would be. And you think that $600 or $650 or $40 doesn't make a difference. Every month, inflation adjusted, it makes a huge difference. A huge difference. But your primary insurance amount is a whole cabal. I just made up a word of a formula that goes into with Ben points to create this formula. And part of it's cost of living adjustment. The other part of it is these average wage growth that I mentioned on the call. If you hadn't heard, average wage growth has been going up in this country, which means it also gets embedded in one part of the Ben point, which bolsters your benefit. It's like adding more meat to your Social Security sandwich. So you might see if you're under 62 years old, you might see a really nice bump to your benefit. I would say pull your Social Security statements from January, February, and take a look.
Yep, absolutely. So talking about retirement benefits, how do you estimate that? And you can go to socialsecurity.gov/myaccount. That's how you can obtain that. SSA.gov, socialsecurity.gov, both great sites. Look at the retirement estimator. And unfortunately, it's kind of like getting into a Brinks truck, because they're gonna send you a paper form with your password, or it's not as easy as just logging into something else like we're used to. So do bring a little bit of patience with you, kind of like how you guys were waiting on us, but more. So your retirement benefit will depend on when you claim it. So we talked about those amounts a couple slides back. You're going to get more if you delay or you wait. And also we need to talk about what happens if you claim before your full retirement age. So at that point, you would receive a percentage of your primary insurance amount. So you can see here, this shows you on a $2,000 benefit. If your full retirement age is 67, so born in 1960 or later, you would receive 70% of this $2,000. That's your PIA, that primary insurance amount. So $1,400. You get a 5% bump each year until 64. At 65, you see it goes up to 86.7% of it, 93.3, and 66, and then you receive that full amount. So keep in mind, this doesn't escalate each year. If you take it at 62, it's $1,400 is locked in. You're going to get the cost of living adjustment on top of it. It doesn't increase like this each and every year unless you delay.
Yeah.
So this is what we were getting at, that a lot of people say, well, at $1,400, heck, $1,600 is, that's only $200 a month. No big deal. Well, that's $2,400 a year. It starts adding up. And then you put those cost of living adjustments on it. It really becomes a lot more substantial. There are times that Rich and I would say, hey, you know what, go ahead and take it. There's an illness. Maybe you don't have anybody who would be claiming off of your benefits. Then yeah, maybe go ahead and take it. We can make some arguments on both sides, but be cautious, understand the consequences if you do take it early. Now, this is the cool part. Rich, if you want to cover this, what happens if you delay till after full retirement age?
Yeah, so if you do that, your benefit's going to go up 8% every year you delay it. So your benefit will be 108% of your primary insurance amount. At 70%, it's 124%. So that is such an incredible bolster to your benefit, not including these cost of living adjustments. One common question I'm getting, Danny, right now is, hey, I'm listening to you, Rich. I listen to Danny, and I'm going to do it. I'm going to wait till 70, but do I get the 8% bump and the cost of living adjustment? Yes. You get both. And again, I don't want you to think like, listen, you can always say like, where am I going to get 8%? Not going to get it in the market, but it's really, this is based on actuarial tables. And why they do this based on average life expectancy. But you know your family history, you know your health, and most likely you're going to live longer than a lot of people in your family, even if they died early. We're just seeing that all the time. So the longer you live, the better this cash flow that comes from Social Security happens to be.
Yep, absolutely. So make sure you understand that and understand your own longevity. We talk to people, oh, I'm not going to live that long. Well, a lot of times it's the opposite case. Well, heck, financial planning would be a heck of a lot easier if we all knew when our expiration date was. We may do things a little bit differently. So this talks about why delay the benefits and what those checks look like. So you look at $2,000 if your primary insurance amount at full retirement age of 67. That same scenario, $1,400, you see at 67, it's $2,000. Well, now we start looking at it with the cost of living adjustment. This begins to increase quite a bit. So if you delay till 70, you're getting that 8% bump. So you see 2,000 goes to 2,480, but in actuality, with the cost of living adjustment of only 2%, you're getting 2,906. So that is not a small amount, especially when you annualize it over each year. And then even from there, you look at it over your lifetime.
Yeah, so you got to remember, look how that's grown. How wide. If you're 85 years old, your monthly income is $2,856. If you apply for Social Security at age 62, or $39.11 if you apply at 70, that's a huge difference, say, in your standard of living. I mean,
look at it from just at 62 to 70, even at 70 years old. I mean, that is a substantial jump.
Yeah, and this again, we're basing it on a 2% cost of living adjustment over the last couple of years. And I actually think, Danny, we probably have another. I think it'll be until, and we'll see if I'm right. It won't be 8.7, but I think you're going to see much higher cost of living adjustments maybe through 2024.
Maybe.
I think maybe in 2025 you start leveling off, because some of this inflation we're seeing is not as transitory as people think. So that will definitely be helpful. So the longer you wait, the bigger the check. And I think that's really, really important.
So, key points to remember: if you apply early, your benefit's going to be smaller and it's going to stay there for life. Cost of living adjustments do magnify that, just as we discussed. And then your decision is also going to impact your survivor benefits for you, for your spouse, for potentially children. Make sure that you are claiming this right. So another reason not to file before full retirement age, that permanently reduced benefit. But this is one I think that bites a lot of people in the rear, that most people don't even know that it's there. So if you file prior to full retirement age and you make more than $19,560 in 2022, for every $2 in benefits over that, or every $2 you earn over that, you're going to have $1 in benefits withheld. I'll give you an example. I had a long-term client, and I told them they didn't need to. Do not take Social Security. Don't do it. Talked to a bunch of neighbors who said, we took it. We're getting everything we can out of it. And get a call a little later, and they said, Danny, you're going to be upset. I said, why? Why would I be upset with you guys? Yeah, well, we took Social Security. Oh, shoot. Okay. Well, it just so happened to be, it used to be you could pay it all back. No big deal. It happened to be where they gave us a 1-year window to pay back, and we were just over that 1-year window. But what had happened is they had to pay all of that benefit back within that first year. So they essentially didn't really receive anything, because they actually had, in this case, they had deferred compensation come in, that they were physically retired, didn't have earned income in other areas, but this money was coming in and it came in as a lump sum, pushed them way over it. They had to go and pay every dollar back, and they locked in a lower rate forever on their Social Security. So be really, really careful here. You can't also, if there's an age discrepancy and, looking at doing some savvy spousal strategies that can typically be a little bit more beneficial, you lose the benefits of doing that. So talk a little bit about the spousal benefits, Rich.
So spousal benefits, when Social Security was first put into place in 1935, most women didn't work. So the system allows for spousal benefits to be paid where a woman can draw Social Security off her husband's work record. So now, of course, most women qualify for a retirement benefit on their own work record, but you still be able to take advantage of what we call these spousal benefits. So here's an example. You got Jack and Jill are married. Jack's PIA is $2,400. Jack files for his benefit, right? And then she applies for the spousal benefit at her full retirement age. See, first of all, you're seeing you both have to be full retirement age, right? So at her full retirement age, she can go ahead and get half of his primary insurance amount. But again, your husband must have had filed for his benefit to trigger the spousal benefit. And then your spouse has to be full retirement age as well. So if you have a younger spouse and you've retired, it doesn't mean that she can take that spousal benefit. Say you're 65, you're 67 and she's 57. She's going to still have to wait to trigger your spousal benefit.
So the coordination of benefits, I think this is another big thing, is that many times you find out that somebody went, one spouse or the other went and actually filed all on their own.
Yeah.
You didn't necessarily coordinate those benefits together. So if you file before full retirement age, you'll receive your own reduced benefit first. Now, if your PIA is less than 50% of your husband's PIA, we actually just got a question on this, so we're kind of answering it here.
Good.
You may also receive a spousal benefit, providing your husband has filed for his benefit. So, and the question we just received a moment ago, it was, hey, I'm still working. What if the spouse takes it at 62, and you don't take your own benefit yet? Well, they can't collect on yours to get that 50% until you take it. And now if you take it prior to that full retirement age or primary insurance amount, that number will be reduced as well. So you'd still get 50% of that benefit. It would just not be as much.
Right, because that formula is going to affect you. If I'm taking it early as my own benefit, I've reduced it, but I'm not going to now bump up to half the PIA. It's because my own formula has been reduced. So that taking it early really affects your benefits, whether you're getting spousal or on your own work record.
Correct. Now, if they made more than you, and even their benefit was more, well, then it'd be kind of a neat point, because they wouldn't be getting a portion of yours. You'd like to be getting a portion of theirs if it wasn't half of what theirs was. So a lot of moving parts here. We get these questions often.
Generally speaking, if you're still working, you shouldn't be taking it early. Unless I did work with a woman, she wanted to retire, but then she wanted to go back to work at Target. And that was fine. But I said, well, how much are you going to make? And she was coming in under that $19,000 plus threshold, Danny. So she was still able to take Social Security early, that she wanted to, and there were reasons for that, but also not have it taken away based on the income she was going to make at Target. I gave her the threshold and said, do not cross it. And she said she wasn't, and she hadn't. So,
well, good. So this is a great example, and this will answer the question we just had a moment ago as well. So Jack's PIA is $2,400. Jill's PIA is $800. Jill files at 62. So her benefit's going to be 70% of that $800. So it's $560. Her spousal add-on will be one half of Jack's PIA minus her PIA, reduced by 35% for early claiming. So what we're talking about here is they still get that 50% of that spousal benefit, but then it's reduced because you filed early. So now you have $1,200, which is what your normal PIA would be, minus $800, and equals $400. Then you actually have to divide that by, or multiply that by 0.65. So that benefit that you receive is not nearly as much. It's at 560 plus 260, so you get 820.
Which is now, less than half.
Less than 50%. Yeah.
Less than the 50%.
It's less than half, but
right.
Because you took your benefit early, you receive a discount from your primary insurance amount, meaning you won't get the full $1,200 that you would have received from Jack if you're Jill, right? So this is where you have to be really cautious, and why we do encourage delaying if you can. There are strategies to get the most out of it, but you're going to be taking a haircut even on that step up for that spousal benefit. It's not going to be exactly that 50%. It will be reduced.
I worked with someone just yesterday who said, oh, yeah, well, I took it early, and my spouse, when my spouse is till retirement age, my financial advisor said to me that I'm going to get 50% of his primary insurance amount. And I said, well, no, you're not. You took a reduced benefit, right? Yeah.
Yeah.
And I went through this with her and showed her that she wasn't going to get half of, I don't know, the $2,800 benefit he was getting. And she was shocked. She's like, well, I did this because he told me that I would bump right up. In other words, no matter what, that half would override her decision to take it early. And I went, no, it's not. And she fought with me a little bit, not in a bad way. And then I said, well, hey, call Social Security. And she did. And she said, you were right. She goes, now I don't know what, it's too late. She's not a happy camper.
No, I bet not. I mean, this is why I'd always run these numbers. So there's a lot of really great software and tools out there. There's also a lot of really, smart people that deal with this on a regular basis. So be cautious, dot your I's, cross your T's. Calling Social Security can be really good or really bad, kind of like dealing with Medicare. Sometimes they don't want to give you all the information or help you make the decision. They just want to give you the numbers. So in that case, they should always give you the numbers, but just keep that in mind.
Like you just said, get a second opinion before you pull the trigger. Do 3 checks to make sure you're doing it right. Because once you file, a window is gonna close on you if you need to pay some of those benefits back to get back into the system and forego all this. So got to be careful.
So now that last scenario was filing early. Now, what if you file at full retirement age? So you're going to receive your own primary insurance amount or 50% of your spouse's PIA, whichever is higher. There is a special option if you're born before 54. You can file what we call a restricted application. So essentially, to your spousal benefit, you would receive a spousal benefit for 4 years while your own benefit builds 8% delayed credit. So this is where you can use something to your ability here or to your advantage, that may actually help you get more out of Social Security long term. A lot of people have already filed at this age group, so it's not pertain to everybody.
I mean, we had it. There are very few that we had in the last few years, but the window's closed for the most. You'll still have some, but pretty much closed.
This would essentially mean that this is only if you're born before 54 and have not taken benefits yet. So file for your spousal benefit at 66, switch to your retirement benefit at 70. So same example, Jack's PIA is 2,000, but now Jill's PIA is 2,400. So actually she has more. Her PIA is higher. So when Jill turns 66, she files what we call a restricted application. So for her spousal benefit, she receives $1,000 a month because that's half of what Jack's is. And then when Jill turns 70, she switches over to her amount, which was 2,400. And now if that's grown with that 8% bump, it's 3,168. Now, kicker, can't do it before full retirement age. Jack must have filed for his benefit, so he cannot delay as well. He has to go ahead and file for his benefit. And then Jack can't claim a spousal benefit on Jill. Only one of you guys can do it. So that's why you'd want to let the highest benefit grow, and then you'd file it off of the other. So we always want to make sure that, we're looking at this properly. Now, divorce spouse benefits, this is a big one, Rich. I mean, we hear about this all the time. What are the caveats on, what are the rules for filing off an ex-spouse?
Well, again, if you were married over 10 years and you're currently unmarried, if you were married to the same husband, you want to pay attention to these rules that are available. So if your marriage lasted, again, 10 years, currently unmarried, your ex-husband is at least 62, you might be entitled to divorce spousal benefits. If the divorce occurred more than 2 years ago, he does not have to have filed for his own benefit. He only needs to be 62. So if you're divorced 5 years, or longer than 2 years, you're okay. But you got to remember that little hook in there. If the divorce occurred more than 2 years ago, he does not need to have filed for his own benefit.
Yeah. So walk us through another scenario on this, Rich.
Well, Dick and Dora are divorced. So they're married 10 years, right? Dora's 62, currently unmarried. So Dick's PIA is 2,400, right? He is over 62. So she goes ahead and she files for her divorce spousal benefit as well. And full retirement age. She starts getting 50% of Dick's PIA on 1200. I know it's hard to believe, but that's true. So Dick's own benefit will not be affected. He has nothing to do with it. His current wife's spousal benefit will not be affected. This is your decision. And Dick's other 7 wives, right, will not be affected, right? So it doesn't matter. They'll all get their own benefit if they hit the criteria here as well. So the Social Security framers probably didn't think through serial marriages would one day become so common when they developed the rules, but here they are.
Yeah.
And we can take advantage of them. So it's important because, again, a lot of women do not know that they can receive this benefit.
Here's another scenario. If you're born before 1954, so once again, we're looking at that specific date, file for your divorced spouse benefit at 66, and then switch to your own retirement benefit at 70. So same scenario, Dick's PIA is 2,400, Dora's now is 2,000. When Dora turns 66, she files a restricted application for a spousal benefit, receives $1,200 a month for those 4 years between 66 and 70. Then when she turns 70, she switches back to hers, which would be 2,640 because it's 2,000 at that time. That 8% bump that she receives each year works out really well. Now the kicker, so we mentioned, had to be born at 54. You have to also been 62 or older by the end of 2015. Like we said, right now, if you're born, you'd be 59 or 69. So not a whole lot of wiggle room here for many people to use this. That window is really closed, as Rich just talked about.
Yeah. Well, you got file and suspend, remember?
Oh, that was
file
awesome.
And suspend, which was really available to anybody where the higher earning spouse could turn his or her benefit on, and then you take your spousal, and then he or she turns it off. That was a cool thing.
It was a great strategy. Unfortunately, they took that away.
Blame Obama. Blame Obama for that one. He took that away.
Yeah, this one's heading that way too. So here's the deal. Dora can't do it before full retirement age. So in her instance, 66, right? She was born before 55. Dick must at least be 62. He does not have to file for his benefit if the divorce occurred over 2 years ago. So as long as you're divorced for over 2 years, you can utilize this. Dick can also file for a divorced spouse benefit on Dora's record. So unlike a regular restricted application, if you're divorced, you could actually both do it on each other versus if you're still married. But, small window for, not a whole lot of people. So we're going to kind of move on quickly here.
Again, there's going to be a point where this isn't in the presentation anymore, but, right. Rarely do. Last time I really had a situation like this was about 2-3 years ago. So
yeah, it's become less and less. In 2015, we were doing this quite a bit. As they were shutting that window, and then it switched quickly. So here and there. So let's talk about survivor benefits. It's something that unfortunately, a lot more people can relate to. So the amount of survivor benefits depends on when your deceased spouse originally claimed their benefit, so their original benefit, and when the widow claims the spousal benefit or what they're actually going to receive. So another type of scenario. Jack and Jill are married. Mm-hmm. Jack's PIA is $2,400. Jack dies at age 70 or later. Now, if he had claimed his benefit at 70, Jill's original survivor benefit would be based off the benefit at the time of his death. So if he was getting $2,976, that's exactly what she would get. She would get $2,976. If he claimed his benefit at 62, that benefit would be based off of 82.5% of Jack's PIA amount. So now we're talking about $1,980. So you see the big difference on when you claim on how it can impact your spouse. That is a lot of money. That's $1,000 a month, basically.
I always ask a male spouse, when he wants to claim early, I'm like, well, how do you feel about your spouse? You like her? You love her? She's younger than you? She's going to outlive you? If you take it at 62 and die, she's going to get a lower benefit. Is that what you want to do? People don't realize that they're making decisions not just for themselves. They're making decisions for spouses and possibly children when it comes to this. So you've got to be real careful on these claiming decisions and not just think of yourself, but others that you leave behind as well, and what kind of benefit they could receive. And it's very, very important. A lot of times there's a study out there that men were taking their benefits at age 62 and not even telling their spouses.
That's
not
a scary thing.
not a good idea, because they didn't think it affected them. Like, they don't know. Like, well, that just affects me. It doesn't affect my spouse. It does. It does. So keep that in mind.
This is talking about the actual survivor benefit based on when the widow claims the benefit.
Mm-hmm.
So it doesn't just pertain to when your spouse passes, but also when you take that benefit. Now, we're talking about that same amount, the $2,400. Assume Jack's guy is $2,400. He dies after age 70. Assume Jill's full retirement age is 67. And we're not looking at any cost of living adjustments here. So $2,400 at age 60. So now here's the kicker too. If you're taking a survivor benefit, you can actually take this, a widow benefit, at age 60. So it gives you a 2-year window that you can open up earlier than a traditional 62. Don't always want to do this. I do realize there are times that you just have to, but if we can delay, you can see these numbers are quite a bit bigger.
I'll tell you what happens, and this is a very important slide for everybody. I've dealt with, and Danny, you have, women that have been married a long time, lose their spouse, loves of their lives, high school love, and they're distraught and they're worried.
Yep.
And they realize they can take this survivor benefit at 60, and they make an impetuous decision because they're worried about money, right? As opposed to, what if Jack had claimed, waited till later, but Jill says, I'm 60 years old and I can take it down. I'm really worried. I'm going to do it, right? She's going to cut her own benefit as opposed to thinking clearly about it. So this is a very, very important, that we do not recommend that a survivor take it at 60, unless, like to Danny's point, you absolutely need it. But I have seen this decision being made out of stress and grief. And, you know, as advisors, we got to work around that and understand and empathize, but also show you're going to be hurting yourself, not helping yourself by doing this. It's really important.
When can those benefits be claimed? We just mentioned you can start that at age 60. Now, if you're disabled, you can actually start it earlier at age 50. Now, assuming your husband has already passed. If your husband dies after you turn 60, your survivor benefit can be claimed immediately, but it will be reduced if you're under full retirement age. And then you guys must have been married at least 9 months, unless it's a case of an accident. So, you know, this is just another point, like you just mentioned, Rich. It really pays to wait if you can.
It does. So here's just an example. Again, that Jack is receiving $2,976, right? He was a good guy. He listened to Danny. He waited until 70. And then Jill's spousal benefit, she goes, well, she doesn't qualify for work on her record. So she goes ahead and she looks at, okay, well, I'm going to take what my spousal benefit, what the combined benefit is. She switches to her survivor benefit at $2,976, and her $1,200 benefit stops. So it's not like you're going to get both, right? But you're going to get the higher of, and that's why when it has a higher earning spouse and a lower earning spouse, regardless of man or women, it just happens the odds to be the woman, that you got to look at the coordination properly and maximize out what the higher earning spouse made and how that would benefit both parties.
Yeah, I think it's a big misconception, Rich, that, you know, a lot of people think that they receive both, right?
Yeah. And Danny, you said it early, which is very true. I think as we progress, women are going to have either higher than the male as far as their earnings, or they're going to have equal. And then it's not going to matter. But for now, this matters. To baby boomer generation, early millennials, still matters.
Yeah, it does. Now, have you seen, I know you've seen this, but there's actually legislation out, or there was, to, instead of, you know, when somebody passes, that you lose either yours or theirs, in the sense that just take the higher, that you'd actually receive 75% of both of those combined. And that would be nice because, we do see, obviously expenses decline, but a lot of times you have some fixed costs that just don't change much. And so that would be really helpful.
Yes.
So divorced spouse survivor benefits, same as the survivor benefits if, two caveats, marriage lasted at least 10 years, you are currently unmarried, or remarriage took place after age 60. So another example, Sam and Sue are married from 70 to 85. Sam died in 95, so been married quite a while. Sue has not remarried. As soon as she turns 60, she's eligible for a reduced divorced spouse survivor benefit. So that's the kicker, it's still reduced. If you delay, it's going to be higher and higher. So even though Sam has passed, if you continue to delay, that number will still continue to increase.
So, I mean, if you look at this, you might want, we talked about this, right? You might outlive your spouse or your ex-spouse. The odds are you will as a woman. So you want to wait till 70. We talked about that, right? Then you want to claim your survivor benefit at your full retirement age or later.
Yep.
And hopefully you'll be well over full retirement age when your spouse dies. But just keep this information in mind. Coordinating the benefits on those survivor benefits is very important.
What qualifies you for retirement benefit and a survivor benefit? So a lot of opportunities for switching between, survivor benefits then with spousal benefits. You can file a restricted application for those survivor benefits. Can start own benefit at 62 and switch to survivor benefit at full retirement age. Or, like we discussed, you can start your survivor benefit at 60 and switch to your own benefit at 70. So this is where it pays to really understand those numbers and say, okay, if I take this number now, even though it's going to be reduced, I'll take my own benefits, let those continue to grow, then let them get the 8% bump until 70. That's a strategy that a lot of times can really pay off. But as it shows here, we talked about earlier, take that higher benefit last, because that's the one that's going to have the most opportunity for growth with those cost of living adjustments.
So if the survivor benefit is higher than your retirement benefit, you're going to want to take, say, your retirement benefit at 62 and then switch to the full benefit, survivor benefit at full retirement age. So here's Linda. She gets her own benefit at 70 at age 62 and then switches to the full survivor benefit at 2,266. If you notice, Danny, the survivor benefit does not get cut like the spousal benefit. And I think maybe that's where the advisor with the person I worked with before mixed up the rules. So with the survivor benefit, you might be able to say, hey, I'm going to take my retirement benefit at 62 because the survivor benefit's bigger. And I'm going to get the max at my full retirement age. So it makes sense then at age 62 for Linda to start getting some money into the household on her record. And who cares if it's got a haircut to it? Because at her full retirement age, she's going to switch and she's going to get the full boat survivor benefit. She's not getting a cut to that. So it makes sense when a spouse dies versus a spousal benefit to coordinate when and maybe take it early. Now you got to keep in mind though, you can still lose $1 for every $2 depending on how much you make. So you also got to look at whether it's worth it taking at 62, right? Say Linda's working. So if Linda's is earning over a certain threshold, they're going to reduce some of her benefit, maybe $1 for every $2, $1 for every $3. So maybe she's worth waiting for it. And some spouses will wait to take, till they say, you know what, I think I'm going to retire at 63 or 64. I'm going to retire before my full retirement age. And then I know I'm going to take my benefit early and I have this spousal benefit. So it all depends on somebody's situation.
So what about if that survivor benefit is lower than the retirement benefit? So this example here, Dora is, her PIA is $2,000. So remember, that's the primary insurance amount at full retirement age. Her survivor benefit's $1,800. Dora would claim her survivor benefit at 60. So 1,800 times 71.5 equals 1,287. Switch to her own retirement benefit at age 70. And so she'd have a much higher amount at 2,480. So you'd see she'd get that increase from 2,000. She'd get 124% of that. So if you're still working under full retirement age, all or part of that survivor benefit could still be withheld because it's still subject to that earnings test. So we need to make sure that you do understand if it's more than 19,560 in 2022, then you would likely have benefits withheld and keep that reduced benefit. So if that's the case and you're still going to work for a while, just wait, delay it. You can still take it later after full retirement age. So the kicker is that this is all that only pertains to you if you're under full retirement age. If you're older or over full retirement age, then you're not going to have any benefits withheld at all. So you can still utilize this strategy. It would just look different.
So Danny, I got a question for you.
Yes,
Why can't you leave your survivor benefit to take care of your dog? What?
Yeah.
Right, when you want your puppies taken care of?
Hey, you think that they would have something on that white and green, your Social Security statement that would cover dogs as well, right? Pets. I know there's a lot of people out there that would love that.
Cover your pets, right? So this is what Social Security and remarriage, right? So if you're divorced or widowed and thinking about remarrying, you got to keep this in mind. If you remarry at any age, you can't receive divorce spouse benefits. So if you're already receiving divorce spouse benefits and thinking about remarrying, you better understand that benefit's going to stop. Now you might be able to get benefits, spousal benefits on your new husband's record. That's a possibility. But if you remarry before age 60, you can't get survivor benefits or divorce survivor benefits. If you remarry after age 60, you can still get survivor benefit or divorce survivor benefits. I know the rules are tough. You don't want to memorize them. You got to also talk to the Social Security Administration, talk to people like us who know the system. But there's reasons why sometimes older people live together in sin. They don't want to lose that spousal benefit. That was an episode of All in the Family that before you were born, Danny. Yeah.
Oh, was it? Okay.
Yeah, and Archie wasn't happy that the older couple were living together. Bothered him.
Awesome.
It was for the money.
All right. So, summary of that survival planning: spouse or ex-spouse is still living. So, encourage spouse to delay benefit to 70. Right. It's always going to be, typically much better, especially if you have longevity. One tool that Rich and I use frequently, we have clients do, is a life expectancy quiz. And I know nobody wants to, tackle your mortality head on, but just like a will and everything else, it does help us plan, right? And so if you could do that, you really get a better understanding, and what your health looks like overall, what your long-term outlook looks like based on genetics and your family. And so it helps us give a little bit better idea. So if you live to 70, we want to talk about what's that break-even point versus if you don't live that long, and that can help you make a better decision when you claim. That would be a cool conversation to your ex. Like you're not married, but you call your ex and go, "Hey, do you think you can delay taking your Social Security until age 70 so I get a higher divorce spousal benefit?" Hello? Oh, you're not there. Oh, what happened? So keep in mind, you want to consider you and your spouse's both life expectancy. And that's what we're talking about. So make sure that you want to maximize benefits, especially, and you got to think about not just your own life expectancy, but both of yours. That way you don't leave any money on the table and you protect each other. I mean, that's the key here. We want to make sure that you guys take advantage of this, but you protect each other, which I'm sure is all of your intent. And then what does survival planning for a spouse or ex-spouse who's deceased look like, right? Compare your own benefit to the survivor benefit. And you may say, listen, I don't have access to that information. That's what you call Social Security. They're going to actually walk you through it. Take the higher benefit last, and then do not remarry before age 60 is the other kicker here, just like Rich was mentioning. So if you're currently married, you want to coordinate your benefits with your spouse. You all have to talk about it, right? You want to optimize your benefits for one or more of you. Who's going to delay to age 70? How are you going to earn the maximum? Who makes more? Right? We run these analyses all the time, but it's really important for spouses to discuss this and not have one trigger a benefit, most likely the male, right? If you're divorced, you're going to want to maximize your own benefit, right? By delaying to age 70, receive your divorce spouse benefit from 66 to 70. Again, you must have turned 62 by the end
of 2015. If you're widowed, you want to coordinate that retirement and survivor benefit, take the higher benefit last, all right? If you've never been married, well, you're going to be on your own record. So maximize your own record as long as possible and apply for Social Security age 70 because you're going to need that money for caregivers. And, I'm worried that there are going to be more seniors living alone, Danny, male and female, and they're going to need cash flow for caregivers. So really important. And it's a lot to remember. But I hope what Danny and I hope is this has opened your eyes to the different options that are available to you that you may not have thought of before. And again, your Social Security Administration doesn't take into account your full plan, right? A lot of times they're going to encourage you. I had one client that was on the fence about taking it early, a widow benefit. And I talked her out of it. I said, no, we're going to do this. And Social Security pushed her, nudged her. Listen, you should take it early, not, in some way encouraging her to do it. And that sometimes happens.
Yeah,
they don't know.
I don't know what their incentive is to do so. I
don't know. Maybe somebody
I've heard that too.
Yeah, so they don't know your full plan. They don't know your full plan. This happened when we had file and suspend, and I would have clients, and we'll get to that office before that deadline closed, and they said it's no longer available. I'm like, wait, yeah, it is. Go back, get me on the phone. It's still available. So, just you want to get the most out of it and think clearly through it and work with a professional who knows what they're doing.
Absolutely. So, planning for an extra long life, what does that look like? I think this is really important to understand that you could live to age 95. You could, how does Social Security, that inflation adjusted income for as long as you live, what does that impact and how does that impact your financial plan in a positive way? Now, keep in mind that decision you make now or when you're younger is going to have an impact on your income for the remainder of your life. So if you take that reduced benefit, it's always going to be reduced. We want to make sure you don't do that. And then delaying it will give you much higher income later on as we saw those cost of living adjustments, even just using 2%, what that did for the longevity or the amount that you receive. And, this is why we feel like, if you talk to, you've heard Rich and I talk, especially on our Financial Fitness Fridays on the podcast or radio, we talk a lot about these things because these are things that we can control. Whereas, we can't control markets. We can control our actions and behaviors and what we do around them, but we can control this. And sometimes, we're forced into a certain situation. But if you can delay, this is where, it's going to give you a leg up long term if you have some longevity. And then make sure you're coordinating. I think that's so really important to make sure that, you and your spouse are on the same page and nobody's taking benefits early unless there's just an absolute necessity to do so. And then also do a full retirement plan. Rich, how many people do you know that say, what do I need for Social Security? Well, I don't know. I mean, what's your retirement plan look like? Or, how do you back into recreating that paycheck? Well, what do you need? I mean, so we're going to look at what your expenses are, what your goals, your objectives. And this is all going to play a factor and a role in determining when you take these benefits. I think that's really important to make sure that it's not just taken out of context and that you utilize this, on a regular basis and update a financial plan. So, that's going to conclude what we have today. We do have a brief survey at the end. Please fill it out. Let us know if you like, number one, if what type of information you guys want to hear, what other topics you'd like for us to cover. We're always, kind of leaning on you guys to make sure that we're giving you the information that you want. Also, if you want somebody from RIA to contact you, we'd love to help you any way that we can. Set your meeting with a certified financial planner. Make sure that, we take good care of you guys. And then sign up for Lance's newsletter. I mean, it's a great wealth of information. We also have a daily commentary that we send out on a daily basis and realinvestmentadvice.com, the blog. So lots of ways to get a lot of information. We're going to continue to do lunch and learns on a fairly regular basis. Our next event will be another lunch and learn with, we're going to bring Lance in to talk about markets, impact, what the big picture looks like, kind of a fourth quarter overview. But we really appreciate you guys hanging in there. So thank you. If you have any other specific questions, you go to Richard at RIAadvisors.com or Danny at RIAadvisors.com. Happy to answer there. Or Real Investment Advice, go to Ask a Question And if we didn't get something today, we certainly can here soon. All right. This one's a little lengthy here. Okay. So, assuming you or your spouse has not worked 35 years, discuss the strategies to increase future benefits by working part-time. What are work credits? How are they earned? Is there some minimum that a person must earn during a calendar year or work period to get the increase in future Social Security benefits? This is actually a great question, right? Because we get this a lot. Can you give examples of the amount of increase in future benefits for different levels of additional years or work periods for small part-time jobs, 2,500, 5,000, 10,000 of income for that period? Now, unfortunately, it'd be tough to really give you an example without knowing your full earnings history. So if you're filling in, you haven't worked the full 35 years, every little bit's going to help because it's going to decrease and take away that zero, the year that you earn nothing. But if it's $2,500, is that really going to move the needle? Probably not a lot. What do you think, Rich?
Well, first of all, Social Security has that calculator. So you can actually do it. You will fill those zeros in very quickly, even with part-time work. Again, if you've been maxing out if you are at the max, then you pretty much, most people have maxed out, I will say candidly, by age 62, Danny. They have maxed out all their earnings. Incrementally, they're not going to get a much greater benefit as they work longer. They will get the delayed retirement credit and the cost of living adjustments and all that. But as far as actual earnings on benefits, not much. But you can make a really big difference working and getting those hours. And that's where the calculator can very much help you.
So, as I mentioned a moment ago, don't hesitate to reach out. We'd love to help you guys any way that we can. If you're a client of RIA, reach out to your advisor if you feel like you'd like to spend a little bit more time understanding Social Security strategies, what that may look like for you, and the overall big picture within the financial plan is something we certainly discuss on a regular basis. And like I said, we'll be back here in a couple of weeks doing some more. And everybody have a great week, and thank you for joining us today.